Hey guys, Taki here. So this video is going to be the most in-depth fair value gap guide, and we're going to be going over things like what is a fair value gap, how do you identify it, what it actually does, and then I'm going to get into the more essential things like how you can anticipate a fair value gap being either respected or disrespected, and then some of the more important and core concepts that people wouldn't really teach in a basic fair value gap guide. But first, let's just get straight into what is a fair value gap. So the fair value gap, if we just decompose this phrase, we can kind of divide it into these two things, fair value and gap. So what does fair value mean? Fair value means that in the markets, when there is a buyer and a seller and the actual thing that you're trading, so in this case the Nasdaq, is at a fair value where both the buyers and the sellers are happy with the price and they both have kind of similar demands to buy and sell. But when there's a gap in the fair value, that means that there is either an excess of buyers or an excess of sellers. So there's a lack of fair value within this certain gap in the price range. So in order to identify this fair value gap, you look at 3 consecutive candles. And if the wicks of the first and the third candles don't overlap, then you have a fair value gap. So in this case, we have 3 candles, 3 bullish candles, and this top wick of the first candle, it doesn't overlap with this bottom wick of this last candle. So the fair value gap would be right here between this top wick of the first candle and the bottom wick of this last candle. Then for a bearish example, if we have 3 bearish candles, then this gap right here from the bottom of the first wick to the top of the third wick, if we draw out a rectangle here, this is going to be your fair value gap for the bearish side. And these both have their own names. So this bullish fair value gap is called a BISI, B-I-S-I. And then this bearish one, it's called a SIBI. So what these stand for, this one stands for buy side imbalance, sell side inefficiency. And this one stands for sell side imbalance, buy side inefficiency. And I think the easiest way that you can think about these fair value gaps is literally just taking a look at this acronym and thinking about what it means. So if we have buy side imbalance and sell side inefficiency, so let's take a look at the sell side inefficiency part first. So sell side inefficiency would mean that the sellers, or the people that are kind of trying to push the prices lower, are inefficient, right? And buy side imbalance means that the buyers, or the people that are trying to push the prices higher, have an imbalance relative to the sellers. So that creates a lot of pressure to push prices higher, because if the sellers were actually efficient, then all of this kind of buying pressure would be mitigated by the sellers. But it's not. So there's a buy side imbalance, and this is what creates this fair value gap right here. Because the buyers are much stronger than the sellers, we get these strong candles with displacement, which creates a fair value gap. In the same way, for a SIBI or a bearish fair value gap, we have sell side imbalance and buy side inefficiency. So buyers are inefficient and sellers have a imbalance relative to the buyers. So the sellers are pushing prices lower, and the buyers, because they are not efficient, they aren't able to push the prices higher at the same kind of level or magnitude as the sellers. So that creates this pattern right here, where there's a strong kind of candle, right, between these two candles. And then it creates the gap right here. And that is the fair value gap. So before we get into the actual charts, I'd appreciate if you guys could subscribe and like. It helps with the algorithm, it helps with my motivation, and you guys also get more of these videos. So it's a win-win for us. Okay, so right here, we have an example of both a BISI and a SIBI. So let's take a look at the BISI right here. So we have a candle right here. This candle right here. We have the second candle right here. And we have the third candle right here. And as you can see, the high of this first candle and the low of this third candle don't overlap. And there's this kind of gap created. So that would be your BISI or bullish fair value gap. You can draw a rectangle and just drag it out. And something interesting that you can see here, we come up, we create this BISI, price comes back down, and then we tap into this BISI, and then price rejects or respect the BISI, and it keeps going higher. And that's how these fair value gaps can be used to predict where price wants to go. You look at them as areas where price would want to reject. And then now if we take a look at something like this over here, we have this candle right here. This candle is low, and this candle is high right here. So there is a fair value gap right here. And what you can see is we come down, we create this fair value gap, and then we come up, but we don't respect it. We just go straight through it. And later in the video, I'm going to teach you how you can anticipate whether a fair value gap will be respected or just violated through, like this one. So make sure you guys stick around. All right, so now let's take a look at another example. So we have a BISI or a bullish fair value gap right here. All right, we come down and then we come up, create this fair value gap, we tap back into it, and we get a move higher. And then now I want you guys to find all of the SIBs in this chart right now. So pause the video and try to imagine how you would mark these SIBs out. Alright, so there are actually two SIBs or bearish fair value gaps here. The first one is right here. And to mark this out, you might think it's something like this, right? Because this is where the bottom of the first wick is, and this is where the top of the third wick is. But I want you guys to pay close attention to these gaps between the candles. So this is called a volume imbalance. It's when the close of one candle and the open of the next candle are not at the same price level. So when you have a volume imbalance, you want to also cover that with your fair value gap. So you would mark it out like this. And then also down here, you have a volume imbalance. So what you want to do is mark out the fair value gap like this. So this would be your SIBI right here. And there's also another SIBI or bearish fair value gap in this chart right here. And it might be hard to see, but it's actually right here. So the bottom of this wick is right here. The top of this wick is right here. So there's a very tiny SIBI right here. So you could draw it out something like this, and then I would have to zoom in so I can get this horizontal movement, right? And then you would mark it out as something like this, right? So these would be your SIBs and your BISIs. And now I want to go over how you can anticipate which fair value gaps will be respected versus which ones will be disrespected. Okay, so let's take a look at this example right here. And in order to anticipate which fair value gaps will work, you want to take a look at order flow or whether we're bullish or bearish, right? So here you can see that we're pretty bullish. We're just making higher highs, higher lows, higher highs, higher lows, and we're just going up. So when we're bullish, we can expect BISIs or bullish fair value gaps to hold. All right, so let's take a look at something like this BISI down here, right? We make this BISI, we come back into it, and then we wick out of it a couple of times, but the bodies are respecting this fair value gap nicely, right? We are holding this fair value gap because we are bullish. And if we take a look at something like this one or these two right here, we come down, we create this fair value gap, we tap into this bullish one, and we just instantly disrespect this bearish fair value gap. All right, so if we go up, we have something like this. We create this, we tap back into it, we go up, come back, tap into it, we go up. And then you have more fair value gaps like these ones that get disrespected because we are bullish. And if we keep going higher, you can see that this was the top of this kind of bullish run, and we swap into a bearish order flow. So we start making lower lows and lower highs. And what do we see when we have bearish order flow? We have this SIBI right here. We create this SIBI, we tap back into it, we respect it, and we keep going down. And then we have something like this down here. So this one, we create it, come down, come back up, respect it, and then just go straight lower. And then we also have something like this BISI right here. Right, we come up, we create this, and then we just instantly disrespect it. Then if we just keep going down, you can see these SIBIs work, right? These SIBIs are being respected. All right, and then down here we get a slight retracement. So now we're bullish temporarily, and then since we're following the higher time frame trend, right? After we get this retracement, we create this SIBI, come up, respect it, and then we make this one again, and come up, respect it. All right, so you can see how when we're bearish, there's a higher probability of these SIBIs or bearish fair value gaps being respected, and when we're bullish, there's a higher probability of the bullish fair value gaps being respected. And as you can see with something like this one right here, it's not 100% chance that they'll be respected, but in this kind of run lower, you can see that, you know, there's a SIBI right here that got respected. There's a SIBI right here that got respected, right? There's a SIBI right here that got respected. And you can see that the SIBIs have a higher probability of actually being respected and working compared to the BISIs. Like you have this BISI that's just, it got violated instantly. And you know, as you can just see from this kind of move lower, the BISIs just have a lower probability of working when we're bearish, and the SIBIs have a higher probability of working when we're bearish. So you can see something like there's a BISI right here, this tiny one, right? It just failed, right? There's also right, there's also this one right here that just got disrespected. There's also this one right here. It didn't work. If we just keep going lower, we have something like this one right here that just didn't work. We also have something like this one down here. This one also didn't work. And you can just see the probability of the BISIs working. They're so much lower than the probability of the SIBIs working when we're bullish, right? So if we keep going down, we get a change in the order flow. So if you guys have seen the video on liquidity, we have the sell side liquidity. We swept sell side liquidity, right? And then now what do? We turn into bullish. So what happens here? We have this SIBI, it got disrespected. We have these BISIs, right? They don't get tapped into, but they're not being violated, right? We keep making these BISIs, we keep making these BISIs, and then as you can see, these SIBIs that we made on the way down, those just get violated through, right? And you can just kind of see how well they work, right? And then now, what do? We come up, we swap this liquidity pool, right? So we have a sweep of this liquidity pool. So now we have a slight retracement. So within this retracement, within this range, after we sweep this liquidity, we're going to be temporarily bearish, right? So we have this BISI, just get violated, we come down. Then after we retrace, now what do we see? We see a change in order flow. So we make this BISI, right? We don't tap into it, but we don't disrespect it. Whereas this SIBI right here, it just gets instantly violated, right? We come up, we create this BISI right here, tap back into it, and then straight up right here, tap back into it, straight up. And then once you can combine fair value gaps with liquidity, that's when everything will click. That's when you can anticipate reversals. That's when you can anticipate which ones will work and which ones will fail. Now I want to get into an example of using fair value gaps with liquidity, and I'm going to be using more advanced concepts for liquidity. So if you guys don't know much about liquidity, then I recommend watching my video on liquidity. All right, so for this example, if we kind of zoom out, then we have this range right here, right? And this high right here is the highest high within the range. This low right here is the lowest low within the range. So these are our external range liquidities. And once we come down and we sweep one side of this ERL, then what do we get? We have these SIBIs right here that we just come down, we create the SIBIs, we sweep ERL, and then we just instantly displace through them. We disrespect them. And then on the way up, what do? We create these BISIs, right? And then we actually respect these BISIs because we swept ERL on the sell side. If we sweep sell side, then what do we expect? We expect a move higher towards buy side. So we sweep sell side, come back up, create this BISI. So we can anticipate this BISI to actually hold since we swept the ERL right here. So we respect it, come up, come down, respect it, come up, right? And then we go towards this ERL right here. And then once we sweep this buy side ERL, then we get a slight retracement lower because on the higher time frame, we are still bullish. But since we swept this liquidity pool right here, we have this BISI right here that just got disrespected. What do? We come down, we sweep some more liquidity, right? And then we go back up, right? Because we are bullish. So we have these BISIs that are created right here. Right, we have these BISIs that are created right here. Right, we have these BISIs that are created right here. And these all hold, or at least they don't get disrespected because we just swept sell side and we are bullish. And then now the question is, how high do we go? So if we zoom out on the high time frame, what do we see to the left of this high that we made? We made this high right here. And if we zoom in, what do we have? We have a fair value gap and we have a high inside a fair value gap. So when you have a high or a low inside a fair value gap, then that becomes an intermediate term high or an intermediate term low. It doesn't need to have two short-term highs or lows right next to it. It just automatically becomes a intermediate term high or low. So if we zoom out again, and then drag this across, what do we see? So we come up, we sweep this intermediate term high, we respect this SIBI, and then we go lower. All right, so once we respect this intermediate term high and the SIBI, what do? We come down, come back up, respect it once again, come back down towards where? This sell side. All right, got a slight retracement, come back lower towards this sell side right here. And then we come back up towards this buy side here, right? And then we kind of chop around a bit and then get one last move towards this sell side right here, or sorry, this buy side right here. And then once we get this move, what do? We create this SIBI right here, come back up into it, tap into it, and then respect it. And then we just get this instant move lower. And then if we zoom out towards where? Towards this intermediate term low and towards this BISI right here. Right? And then once we sweep it, what do? We have this bearish fair value gap, disrespected, right? These bullish fair value gaps are being respected or being held, right? We have something like this. Tap back into it, go up towards where? This SIBI right here. Right? Respect the SIBI, come back down towards this BISI right here. So we have this BISI right here. Tap into it, and then we go higher. Why? Because the move towards the downside, towards sell side, already played out. So once we reach this intermediate term low and this BISI, that was the terminus for this move towards sell side. So now we're swapping order flow to bullish. So we gotta move higher. we get a slight retracement, but overall we are bullish, so we are going to go higher overall, right? So we have these BISIs being respected. We have something like this one is not as clean, but we have this BISI, right? We kind of chop around into it and then we go up. We have this SIBI right here being disrespected, right? We have this BISI right here being respected. And I mean, you can just see how if you combine liquidity and these fair value gaps, you can really get a good read on the market, right? And then determinants for this move, where would it be? Maybe we have to zoom out. Determinants for this move, it has not played out yet. There isn't anything good towards this left hand side that we can actually target. Something like this, maybe like these highs right here, would have been a good spot to expect a terminus, but we, as you can see here, we displaced through it. So what does that mean? That means that this level right here wasn't strong enough to actually be the terminus. So maybe something like these highs up here, they'll be the terminus. And the part of trading is, you know, anticipating or predicting where the market will reverse or stop or, you know, do whatever. But also another part of trading that's really important is reacting to what's happening. Because if you said that, you know, we have these equal highs right here and that will be the terminus for this buy side move, right? And then you were anticipating a reversal right here, you would have definitely gone and stopped out because this still looks pretty bullish. Right? We can see how strongly the candles closed above this level, right? We even have this BISI right here and we are disrespecting it. So that shows that we are still bullish. If we were actually bearish, then what I would expect is, you know, we have this candle right here, we would close below this BISI, we would disrespect the BISI, right? So maybe we would get a move, something like this. So we come up, we come down, disrespect this BISI, right? Maybe we retrace a bit and we just keep making this lower low, lower highs kind of formation while we disrespect all of the BISIs right here. We disrespect these, and then on this move down, we would make some SIBIs, we would respect them, right? Make some SIBIs, respect them. And that's kind of what I would expect to happen if we were actually turning bearish here. But since it doesn't show this kind of bearish momentum, I would still expect that, you know, we are bullish overall. All right, and then now I want to get into kind of the concepts that are a little more advanced that you wouldn't really see in a regular like basic ICT fair value gap guide. All right, so this concept that I want to go over is using the consequent encroachment of the fair value gap. So the consequent encroachment is just the midpoint, the 0.5 of the fair value gap. And on TradingView, if you just double click your rectangle, you can show the middle line here. And in order to actually use the consequent encroachment, you want to take a look at whether we are trading into the consequent encroachment or not. So in this example, we made this BISI right here. And then when we trade into it, you can see how we left this bottom part of the fair value gap unfilled. So we only traded into this kind of top half, right? And then we didn't come into the consequent encroachment. So that is a very good sign for bullish signature. If we stay in the top half of the fair value gap, then that's really, really good for a bullish signature in price. And if we have something like this, right, this SIBI, right, we have the consequent encroachment right here, we stayed in the bottom half of it. So that's a really good signature for bearish price. And you can see, right, we tap into it, instantly displace lower, and then we get this huge bearish momentum downwards, right? Here also you can see we get this fair value gap, tap into it, respect the consequent encroachment, we stay in the top half of it, and then we get this huge candle right towards this upside move. And if we take a look at something like this one didn't respect the consequent encroachment. We tapped into it and then we wicked through the whole thing, right? So we traded through the consequent encroachment. We didn't stay in the bottom half So what do we get? We get a move, we get a bearish move, but it's not as strong, right? We get some strong candles, but we kind of just come back up and then tap into this fair value gap again, and then, you know, come a bit lower, come back up, tap it again, and then get a dump here. But compared to something like this, right, you just get one candle that just taps into it and then instantly displaces up, and then we don't get another kind of retracement into this fair value gap until a lot later, once we actually turn into bearish order flow. And then the same thing right here, we just get a tap into it and then we just instantly displace lower, right? We don't like just come down and then come back up and then come down, come back up and then get a move lower. We just come up, tap, and then instantly lower. So that's how you can use the consequent encroachment of the fair value gap, and it can definitely show you some very good signatures for bullish or bearish price action. So make sure you guys are looking at the 50% mark of your fair value gaps. All right, so lastly, I wanted to just combine everything that we have. So we have liquidity and fair value gaps. So I wanted to just combine those and kind of just explain how you could actually find a trade, because I mean, that's what we're here for, right? Actually finding a trade instead of just identifying the fair value gap. So here I'm on the 15-minute time frame now, since I mean, we don't want to be using, you know, the same examples throughout the entire video, but it'll work on any time frame because time is fractal. So here we have a good example of using fair value gaps and liquidity. So here we have this fair value gap, and then we have this low, this swing low, this sell side intermediate term low, because this is a fair value gap, right? Then what do we do once we come down? We sweep this intermediate term low, and then we can start looking for long entries. So what do we have here? We have a fair value gap, a bullish fair value gap right here, right? We also have a bullish fair value gap right here, right? And you can take trades off of either one of them. So there is a SIBI right here, this SIBI right here, but we are expecting this to be disrespected, because once we come down and sweep the sell side, now we are anticipating a reversal, and from this kind of move higher, we can see that we are making higher highs and higher lows. So we are swapping order flow from bearish to bullish. I wouldn't really want to be taking a trade off of this first fair value gap, since we don't have a strong enough confirmation yet, but I would be comfortable taking a trade off of this second fair value gap right here when we retrace into it, because we can clearly see we have this high, we have this high, this is a higher high, and we have this low, and we have this low, which is a higher low. So I would be pretty confident that, you know, we're starting to turn into bullish order flow. So if you wanted to take a trade off of the first fair value gap, you would put your limit right here, right where the fair value gap is, and then for your stop loss, you could put it just below this candle that made the fair value gap. So this would be something more like a 2022 model, if you have learned that. But this would be kind of a good place to put your stop loss. You could also put it further down, but there isn't really a good place to put your stop loss in this kind of run here. So that's why I would prefer entering a trade on this second fair value gap. But let's just say that you did take this trade, then where would you actually target? So what do we have here? We have low resistance liquidity. And when we have low resistance liquidity, we expect a rapid price move up. So you can just target all the way up here. All right, let's look to the left if there's anything. Okay, so we have this high right here as well. So these are relative equal highs, right? So you can actually just target the top of this relative equal high. And let's see, what else do we have? We have a fair value gap up here, which can also be used as a draw on liquidity, right? Because we want to be filling all of these inefficiencies, and fair value gaps are just inefficiencies in the market, right? When one side has an imbalance over the other. What you can see here, we came into this fair value gap and rejected lower. So you could have targeted this fair value gap right here, or maybe the consequent encroachment. But realistically speaking, I would say if I were to take this trade, then I would be most comfortable with putting my take profit right here at the relative equal highs, because we have this low resistance liquidity and I'm expecting a huge price move up. And I know for a fact that this would get hit, or at least most of the time this should get hit. And as you can see, if you actually took this trade with this stop loss and TP, would have been a 17-hour trade, which I don't think is too realistic, but just shows what you can do theoretically with these fair value gaps. And I think a more realistic entry would be this second one. So this one I would be more comfortable with taking, since we have an actual place to put our stop loss. So I think a good place to put the stop loss would be just below this swing low, right? And then we can target, we can target the same thing. We can target these relative equal highs. If you're not comfortable with targeting all of this, you could just target, this swing high right here, down here. Or you could also target this fair value gap down here, right? Like this one right here, since we haven't tapped into this fair value gap. So that's the unmitigated fair value gap. And we expect those to be used as a draw on liquidity. And if you took this trade, it would have been a 3-hour trade. And that's definitely good enough. Right? You don't need to be going for these like 20-hour, 15-hour, whatever trades, right? You just need, 2 to 3-hour. And then you just keep, consistently banging out those 2 to 3-hour trades, and you will definitely become profitable over time as long as you have a strategy that works, and as long as you manage your risk, manage your psychology, and just be consistent with your trading. So another place that you could have kind of targeted, let's see, we have a intermediate term high right here. So we have this fair value gap, and then we have this high inside it. Technically we did wick outside of it, but it is still considered a intermediate term high since the body closed below. So this entire candle would be considered inside of the fair value gap. So you can target this intermediate term high as your draw on liquidity. What else can you target? You can also target this fair value gap up here, maybe. Right? Or you could just target these relative equal highs, since low resistance liquidity, relative equal highs, and that just really makes a good draw on liquidity. So let's go on to another example. Okay, so let's take a look at this example right here. So in terms of liquidity, right, because that's the first thing we want to be looking for. So before we look for any, fair value gaps or, breakers or whatever you want to use to trade, we want to take a look at liquidity. So what do we have here? We have, let's say the range is, this is kind of the entire range, I would say, but this is a bit too large. So I would kind of refine that range. Let's say this range would be a good place to look for. So in terms of liquidity, we have a lot of buy side that was swept. We have this that was swept, this that was swept. We have all of these that were swept, this, and then we have this as well. And on the sell side, we have a bit of low resistance liquidity, right? It's not too clean, but I would say this is low resistance liquidity. So I would be expecting a move lower because of just how much buy side liquidity we already swept and how much sell side liquidity there is below. And then what we can see here, this is the 830 candle. So I presume this was NFP or something because of these large wicks. So this is when New York session starts, right? And then we come towards 9:30, and this is when the actual stock exchange opens. So this will be a good time to look for a move to play out. And in fact, we get this huge displacement lower, creating this fair value gap. And then we get a retracement into it. So what you could have done is take a short position here with the stop loss above the candle that created the fair value gap. And then where could you target? You could target all the way down here, because this is where the external range liquidity is, right? So this low right here, you could target this 2.83 hour trade. That is good enough. You could also target maybe this fair value gap right here. That would give you a 1.28 hour trade, which it's not the best, but it's decent, right? And once we sweep this sell side right here, we can look for a move higher, because this is the external range low, right? So let's see if we got any good moves higher. We have, for the drawn liquidity, we have this high as the external range. We have this as the intermediate term high. And as for the entry or the fair value gap, there's a nice entry right here. So we have this fair value gap that got tapped into. We could place our stop loss beneath the candle, or when the fair value gap is big like this, you could also put it below the consequent encroachment, because if we are truly bullish, then we should just stay above the 50% level or the consequent encroachment. So you could take something like this, target intermediate term high, and then that would have played out 5.23R, or you could target external range high, which I'm not sure if it did play out, and you would have gotten stopped at break even or at a loss, depending on how you manage your position. But if I were to actually take this trade, what I would do is at this first kind of intermediate term high, if my TP was up here, I would take some off. So I would scale some of my contracts out. So maybe take like 50% off and then move stop to break even. So if I entered on this trade with like 2 NQ contracts, then I would take one off right here and then move my stop to break even. So that way, even if price comes back down like it did right here, I would be in profit of 1 NQ contract times, how many points is this? This is 159 points. And then even if the price comes down, I wouldn't take any losses, right? I would just get stopped at break even. So I would be up 1 NQ plus, or 1 NQ times 159 points on this trade. So I mean, that's how you can kind of just use your fair value gaps and liquidity pools to also manage your trades, not just take the trades. And I think I want to go over one last example, if I can find a good one. Actually, this one looks pretty good. So what do we have here? We have this might be an equal low here. I think, yeah, this is an equal low. So we have these equal lows, right? We come down, we sweep it with a lot of displacement. So once we get this move down, what do we expect? We expect this fair value gap to stay as a SIBI, get respected, right? So we expect something like come down, come up into the fair value gap, and this should be respected and then go lower. But what actually happens is we just kind of slowly grind our way through. So that just tells us that this fair value gap does not want to be respected, right? We also have these imbalances or these fair value gaps down here. And this is a new week opening gap, which I've not taught yet, but you could mark it out, right? And then we can also see that this was used as a confluence for us pushing higher. But if we take a look at this kind of leg up, then what do we see? We have this busy and we are respecting it. So that gives us an idea that we are bullish. I wouldn't want to actually take an entry off of this because we are in a SIBI. something like this, I would not want to take, right? Because we are in a SIBI right now. So there is enough reason for price to go lower. So I wouldn't take a trade off of the first retracement into this fair value gap. But this fair value gap does give us a good idea that price does want to go higher. So this fair value gap we made, and this one was kept open. So that is a breakaway gap, which I will teach in the next video. But what do we also have? We also have this fair value gap that was respected nicely. This one you could take a trade off of. So what you could have done here, probably not take a trade off this first one just because there isn't enough confirmation. But once we respect this go up with this displacement, then you could think to yourself, right? Okay, this is turning bullish, so longs are looking good here. You could put a limit here, right? Maybe put the stop below the candle and then target all of this kind of engineered buy side. So these are LR, or low resistance liquidity. So you could target these, right? And what would happen? You would get the fair value gap made on this candle once this candle closes, and you wouldn't retrace into it. So what you could do is once this candle closes, now you have another fair value gap. You can move your limit higher. So now it's off of this fair value gap, put your stop below the candle, right? And then target the same thing. So this top of this low resistance liquidity, then it would have been a 2.42R trade, which is definitely good enough. Because I mean, as I said, you don't need huge 10R, 15R, 20R trades. You just need to consistently bang out these 2R, 2.5R, 3R trades. And if you can do that, then you'll definitely become a profitable trader. And then once we sweep this buy side, what do we get? We get, there isn't anything too good. There's a tiny fair value gap right here, but I wouldn't really want to trust this because it is so tiny. And then we get a retracement lower, come into this fair value gap again, right? So what is this now? This is relative equal lows in a fair value gap. So it's both an intermediate term low and a relative equal low. So this is a really good drawn liquidity, both has a price magnet and a place to look for reactions off of. So we get this nice reaction higher. We have this SIBI that got disrespected, right? So now we want to be looking for longs, because if we were bearish, then this SIBI should get respected. And what do we have here? We have a BISI. This isn't the cleanest BISI. We just kind of chop around, come out a bit, and then respect it. So it's not the cleanest. I wouldn't really want to look for any trades around this. Yeah, since this is not New York session yet. But what you could do, you could look for this fair value gap, right? Because this is 8:30. So this is when New York session starts, or the New York kill zone starts. So you could take a trade off of this fair value gap. Maybe put the stop below the fair value gap, or yeah, I think put the stop below the fair value gap because this wick is way too large for a stop loss. I mean, you could do it and then target something like this external range high, right? And then what would that be? That would be a 1.8R trade, so it's not bad. But if you put your stop below the fair value gap, it would have been a 4R trade, which is better. And I mean, it's not always better to go for these high R trades. Sometimes it's just better to take the high probability, like the lower RR but higher probability trades. But that's just something that you have to kind of experience yourself. I guess it just depends on your how risk averse you are, just your personality, if you want to go for high RR low probability trades or a high probability but low RR trade, right? So this is something that you could have taken, right? This initial, or this first fair value gap, it wasn't the best, I would say, just because of the time right? This is 7 a.m. And if you know about the ICT kill zones, then you would know this is not within any of the kill zones, right? The London kill zone is 2 to 5, so it would have ended here, right here, 5 a.m. And then right here, it's just kind of not in any kill zone, so you wouldn't expect the most efficient price action. So this trade wouldn't have been the best. But the second trade is really, really nice because we have this liquidity sweep, right? And then we get this move higher, and then retrace back into the fair value gap, and then we have a really nice liquidity pool to target. What else could we have done here? Let's take a look at something like this one. This one, we have this busy and then violate it, come down, make this SIBI. Would I want to take a short here? I honestly really wouldn't. I'd have to check. Let's see. So on the higher time frame, we are kind of just bullish. As you can see, we're making these higher highs and higher lows. So I wouldn't really want to be looking for shorts here, or at least until this gets ran out. So this would be your external range liquidity for this kind of entire range. I would be aiming at this as my drawn liquidity. So I wouldn't want to be going against the drawn liquidity, against the trend. So I don't think this would be the best trade. And let's see if there's anything else. So once we run this out, let me see. These ones aren't too clean because this is at all-time highs. So at all-time highs, the conditions are pretty bad because there isn't a drawn liquidity on the buy side. Yeah, I don't think there is too much that you could actually look for here. Once we come down, like this one is, I would say, decent. There's a busy here. So we come down, we sweep all of this sell side. So we have like low resistance liquidity right here. And I mean, you can see how strongly these low resistance liquidities work, right? You just see this huge candle displacement lower. And then we have, do we have like a fair value gap? Maybe. Yes, we do. So fair value gap right here, tap into it, and then instantly displace higher. And then, I mean, this is a bit choppy, so it's not the best, but you could definitely take a trade right here, but I don't think this would have worked out. So if you put your stop below the candle, you would have gotten stopped out, and there isn't really any good place to put your stop loss here. So yeah, I guess that wasn't the best. I mean, theoretically, if you did this, then it would have been a 2-hour trade, but that's not as realistic because, I mean, this stop loss is way too big, right? I think realistically, you would put your stop below the candle low and then just get stopped out here. But it is, I mean, part of trading, right? Losing is part of trading, and just, you know, taking a couple of losses, it doesn't really matter as long as, you know, you have a edge in the markets and the probability, right? You just have to let it play out. You just have to take a bunch of trades, and then if you have a positive expectancy, then you should be in profits over time. Let's see if there's anything good here. I don't think there's anything too good. Maybe this one. Yeah, maybe this one. It's not the best, I would say, but yeah, actually this one's really nice here. I like this one. So what do we have? We have these lows swept. Did we sweep these? Okay, we didn't. We have a fair value gap right here. See if it lines up. No, it doesn't. Okay, but there's a rejection block, which I haven't taught yet, but there's a rejection block right there. which lines up with this. Then we have this low that's made, then we sweep the liquidity, then we get a move higher. Technically this would be a breaker, which I also have not taught yet, but you could enter off of this, stop below the candle low, and then target, or could you target probably one of these fair value gaps. That would be a 2.5 hour. But I mean, at this point, I feel like I'm just kind of cherry picking. I think realistically, a good TP would be right here. Yeah, I think this would be a more kind of realistic trade that I would actually look for, take a trade off of, and this would be kind of the realistic TP and stop loss. But yeah, I mean, as you can see, like these fair value gaps work really nicely, but just with the fair value gaps data, it doesn't really work too well. So you have to combine them with liquidity, you have to combine them with other confluences. And in the next couple of videos, I'm going to be going over a whole lot more confluences that you guys can use in your trading. So make sure you guys are subscribed so you guys don't miss those videos coming up. It'll be very, very valuable. All right, so that's it for the video. I hope you guys learned something new. If you guys do have any questions, make sure to either leave them in the comments or join my Discord and ask me there. And I hope you guys have a good time trading.